Community Capital Live is a collaboration of a few different entities, all with the focus of bringing accessibility and information to people around the impact and local investment funds around the country. So this is a collaboration between the Main Street Journal, Neighborhood Economics, Impact Alpha, and the Mindful Marketplace. Our panel today is going to be just myself. I'm Joel Skeen from the Mindful Marketplace show on Biz Radio US, and Michael Schumann, the editor-in-chief of the Main Street Journal, and also the author of several books on local investing. If you're on here, you've probably heard of his books, but in case you haven't, definitely check out Put Your Money Where Your Life is his most recent and updated book. And make sure to subscribe to the Main Street Journal. Also, make sure to check out Neighborhood Economics, an upcoming conference that we have that's going to be gathering impact investors, social entrepreneurs, and other community leaders and communities of faith to do collaborative community development. Check out Neighborhood Economics and the upcoming conferences that they'll be hosting. And our guest today joins us from the New Jersey Community Capital Fund, Bernel Hall. Bernel, thanks so much for joining us here today. We are glad to have you.
Thanks for having me, Joe. Pleasure to
Yeah,
be.
we were connecting a little bit because I live in Asheville, North Carolina, and you grew up over on the other side of North Carolina, but you are now up in New Jersey. Tell us a little about your story. What took you up there?
Sure. I am a proud native of Jacksonville, North Carolina, Camp Lejeune, Marine Corps Base specifically. I went to North Carolina State University undergrad, where I ran track, majored in business. After undergrad, I worked in Charlotte for over 3 years at what was then Nations Bank, kind of dating myself, but then became Bank of America. And then from there, I went to business school at Harvard Business School, and after completion of my MBA, I went to Wall Street and worked for UBS and Goldman Sachs. At which time I decided that I wanted to do well while doing good, and that at that time we had started working with what are known as CDFIs, or Community Development Financial Institutions. And CDFIs have the core mission of providing economic development financing and real estate financing to small business owners and real estate developers who are looking to expand their business or invest in communities that have basically experienced sustained disinvestment, and bring about economic growth that trickles throughout the community. And so, fun learning about the industry and having an opportunity to work with the industry in various capacities prior to. I moved over into the CDFI industry and had the good fortune of becoming a president and CEO of New Jersey Community Capital, which is a large CDFI located in New Jersey.
Yeah, that's fantastic. Could you tell us a little about, so I remember when I got to have, I think, I was talking with Sidney Williams Jr.
Yes.
About that divestment in a lot of the communities that he's worked with up along the East Coast there. What is the community there in New Jersey? What has that divestment looked like, and what really spurred the need in your mind for New Jersey Community Capital?
Great question. So New Jersey is one of the more heavily property taxed states in the United States. Also, there is significant disparity among both as it relates to wealth, both from a ethnic standpoint, but also just from a general income standpoint. And so the need there is for quality, affordable housing, as well as economic opportunities that is not solely dependent on corporate hiring practices, aka entrepreneurship financing.
Yeah. And so are you guys the clients of community, like the type of investments that you all are making, are they primarily into businesses from that divested community, or is it more of a smattering of different types?
Sure. As per federal regulations, at least 60% of what we do has to be invested in either low-income housing, census tract, or into businesses that are led and or support people from underrepresented communities. As it relates to this particular CDFI, New Jersey Community Capital is 35 years old. We have a loan fund, which is what you will find in all CDFIs, but we also have a nonprofit real estate development company, which builds affordable and mixed income housing as well as urban retail, as well as a small private equity fund that invests in middle market to smallish businesses with EBITDA roughly $1 million or more that are hiring locally. Because what you find is many of those businesses, as they grow, they tend to hire locally, buy supplies locally, and when they grow, they stay local, which supports obviously schools and the infrastructure of the town for which they function.
Yeah. We're going to kick it over to more details and everything, but I'm curious on the housing stuff because that is such a pressing issue in so many communities, especially here where we got hit by the hurricane here, and we now are, our homeless population, which was already a problem, has really grown, and affordable housing is, top of mind for a lot of people. What has that looked like in the affordable housing development you guys have been able to fund?
Sure, sure. So we've done about $2 billion in overall development cost over the 35-year history of the organization. Much of that, again, is housing that has at least some level of affordability. We've done both for sale as well as multifamily housing. We found that we can use affordable housing production as a way to create generational wealth for underrepresented communities. One of the great programs we have beyond just financing the development of multifamily affordable housing is our down payment assistance program, where in partnership with a lot of banks, we are able to raise grant funding to give up to $35,000 in down payment assistance per family to families that are looking to realize the dream of home ownership. Many of those families are from low-income communities, all walks of life, all ethnic types, some led by single mothers, some traditional family constructs, all looking to have the opportunity to call themselves homeowners and pass that asset over to their children over time.
Yeah, that's fantastic. I mean, when we can bring the ownership of our businesses local and especially the ownership of our homes and our land back local, that's man, you're pulling at you're ringing my bells, pulling my heartstrings, whatever it is. Yeah, so I appreciate it, man. Michael, I'd like to kick it over to you, and kind of just let's open it up for kind of further discussions here about the fund and about how others can get involved.
Great. Well, Bernal, one of the books that I assign my economics students or encourage them to read is Poverty by America by is it Desmond Matthew Desmond? That's it. I was looking at my shelf, and he makes the argument that New Jersey has done relatively better at providing affordable housing because for 50 years there have been real requirements on all developers to do more of this. And maybe you could talk a little bit about the political environment that you've done all of these initiatives in, because it might give others on this call some sense about what are helpful state legislation pieces that could really move affordable housing faster.
Sure. New Jersey is a state of many municipalities, although one of the smaller states from a landmass standpoint. It has over 700 different municipalities, which has pros and cons. The pros are the ability to go from one municipality to another and build housing that's not necessarily contingent on the permitting or entitlement process of a large, massive municipality that may have a backlog of construction permits pending. Because a lot of times, affordable housing deals don't necessarily die due to legislation. They die due to bureaucracy that holds up the ability to have a small or a mid-sized developer get the entitlements they need to begin the work. Because as that, the entitlement process is going, a lot of these smaller affordable housing developer are paying carrying costs, whether it be the taxes, whether it be cleaning up the properties, or whether it be paying appraisers or other third parties as they prep to start going vertical. But New Jersey has been at a forefront of trying to at least create builder-friendly legislation to enhance the work done by the private sector. I had the good fortune in my prior job as head of economic development for the city of Newark for its economic development corporation, Invest Newark, founding or co-founding under the leadership of Mayor Raz Baraka, the first land bank in the state of New Jersey's history. And basically what a land bank does is it organizes publicly owned, in many cases, dilapidated properties and land, and really works to, in a responsible way, with very succinct affordability goals and very succinct usage goals, get those properties back on the municipal tax roll by giving them in the hands of, to the hands of developers that kind of share interests that are aligned with the municipality, whether it be certain affordable housing unit production or even mixed income housing, because sometimes you don't want to reconcentrate an impoverished population. You actually want to kind of mix it so that you diversify the property tax base as well as the type of people living in certain neighborhoods, which tends to be more beneficial to a community. And so New Jersey has been at the forefront as it relates to the land bank. The other thing is New Jersey does have an affordable housing land trust, which basically states that if you do a certain density of housing, certain amounts of fees have to be paid into the affordable housing land trust so that that money can subsidize the construction of affordable housing, if not in that particular project, in a project that is pending in the same municipality. So those are just two ways in which New Jersey has really sort of tried to have affordable housing production as best as possible, stay in lockstep with market rate housing production.
Right, that's helpful. So you mentioned there are three components to what you're doing: a loan fund, a housing development company, and a business development company. Maybe just dig in a little bit with each on what their size is, the number of staff you have, and the
Yeah.
number of loans you're able to do in a given year.
Sure. So we're just under $700 million asset organization. As I mentioned, there are three components. One component is our loan fund, which is traditional to all CDFIs, a community development financial institution. In fact, the state of North Carolina has a great one led by a good friend of mine, Kevin Dick. It's called the Carolina Small Business Loan Fund. But just speaking back to New Jersey Community Capital, our loan fund currently has a portfolio of just under $160 million in loans. 82% of those are real estate focused. The balance is small business loans. 57% of our loans are to women and minorities. Most of the lending is to lower income census tracts, which obviously is relative in a state like New Jersey, where, you know, as it relates to median household income, it's a little wealthier versus the national average. And then in terms of annual volume, and this is just speaking to the loan fund, we roughly do about $60 million a year in loan volume. So moving over to our real estate company, which is called the Community Asset Preservation Corporation, or CAPC, we have a unit count of roughly 500 units of housing. And that has been sold down from 700 units because we'd like to recalibrate our portfolio to be a mix of both single family for sale affordable housing as well as multifamily rental housing. And so we're now sort of recalibrating because we were very heavy on our single family footprint. And we really want to sort of, again, portfolio manage because it really kind of helps us with cash flow on an ongoing basis and allows us to do more work for our underrepresented communities if we have more sustainable rental income. So we're balancing that out. But CAPC is roughly has roughly $118 million in assets. And we're looking to do roughly 800 units, either through acquisition and or some combination of development over the course of the next 12 to 18 months.
Great.
As it
No,
relates
go
to
on.
the third prong, which is called University Ventures, or our private equity business, it is the newest of all three areas. Right now, it's a $4 million fund. We're looking to scale that. We brought in people with a private equity background, but with a heart for community. We are working with banks and others who are looking to do more program-related investments, which tend to be more impact focused, not just profit focused. But we are looking to be profitable on that, because obviously, even if you're doing impact investments or what we call sort of empathetic private equity work, you still work with investors who are looking for a return on investment. So that business is, again, smaller and newer, but we're looking to scale it as we move forward. And that sort of is the umbrella of things that we focus on here at New Jersey Community Capital.
And would that business be focused on legacy businesses or startup businesses?
Legacy businesses. We're not venture capitalists. We really like to see a business with at least 5 years of operating history, led by someone who has maybe even at another company performed the same work and has a great deal of experience. And the reason why we're there is because we clearly have to recycle our funds, and venture capital tends to be one of the, it's like baseball. You gotta, if you go 3 for 10, you're a Hall of Famer. We don't have the ability to have a 30% hit rate. We actually have to be higher than that. So we are looking for a little more experienced operators that are looking to scale from, like I said, $1 million to $5 million in EBITDA up to the next level of growth.
Got it. Okay. So you've mentioned a bunch of different kinds of sources of capital that have come into this. So, some are from CDFI grants and loans, some are from banks and PRIs, some are, I'm sure, from philanthropists, and some from the state. Is there a role, or have you contemplated a role for grassroots investors?
Yeah, no, we're currently talking to donor advised funds, as well as one of our board members who actually has been pretty prolific in crowdfunding, about how we can truly create a vehicle that is risk adjusted in a way in which it creates a path for people to invest in the community for which they live and work. Obviously, as you know, well, there's a sensitivity around non-accredited investors versus accredited investors. There's a lot of liability and SEC regulations around that. So at this point in time, anyone can donate, right? So we clearly make that possible. We even have a donate option on our website, NewJerseyCommunityCapital.org. But as it relates to scaling the ability for people who are non-accredited investments to invest for return beyond our employees, who we do already give the ability to invest back into the company, we are at the early stages of creating a vehicle that has passed all the legality tests in order for people to start investing directly in our fund.
So I appreciate you're at an early stage of thinking about this, but are you imagining that this investment vehicle would only be available within the state of New Jersey or the New York metro area, or make it nationally available?
No, I would definitely be national. As you know, part of our growth strategy, as part of our strategic plan, is to broaden our geographic footprint. Currently, we make loans in New Jersey, Pennsylvania, New York, and Florida. Our real estate footprint is in 36 different states. So, as I mentioned, I have 3 different business lines, and they actually are in different places as it relates to where they currently have a footprint. But we're looking to take everything national at this point in time. So we'd be looking for investments from all over for people who had like-minded interest.
I've got a ton of questions. Let me just ask one more, and then I'll kick it to Joel to open it up to our esteemed audience here. Um, you have a lot of buddies from Goldman Sachs and UBS. Have you been able to get them to step up and invest in this as well?
Goldman Sachs has invested in our real estate fund. We don't have a credit relationship with UBS at this time, but they never had a strong loan or PRI exposure to CDFI, so it's kind of not their cup of tea, and traditionally hasn't been. But yes, we have a great relationship with Goldman, both on our on the lending side of things as well as new market tax credits.
Great. All right, Joel, back to you.
Yeah, love it. You mentioned earlier, kind of the needing to still have that ROI on the return in order to, while doing impact, still having that return. And I'm curious, when you talk to your either institutional or your other investors, what's the conversation like around whether that's kind of slow capital, or what Kevin, who's usually on our calls, always says is, that there's a cost of doing good. Now, there's also a cost of not doing good, obviously, but that there is still a cost to doing good. I'm curious, what is y'all's perspective on that cost of doing good and how that gets prioritized?
Sure. I agree that there's no growth. I'm equitable growth without growth. So we're very honest with people about the fact that, we're not going to rival, I was going to name a name, I won't do that, a well-known private equity fund with respect to our returns, but we will outpace them as it relates to our impact, while being north of treasury and the weighted average cost of capital of most people's lives, right? Basically, what you're paying to live, whether it be your car, payment, interest rate, and or your mortgage rate, right? Because obviously, if you're not beating that, then you're really not being accretive to people beyond just the feel good part of the business. But it's all risk adjusted. At the end of the day, we want to recycle capital, right? In a way in which it not only is good for the investor, but it is also good for the people we're invested into.
Mhm.
Because in doing so, we believe the social economic piece of our work also translate into real dollars, right? There is a study by Citigroup where it talked about, the cost of people from underrepresented communities not participating in the economy, and it's $16 trillion between 2000 and 2020. And that number supposedly, and this is not firm yet, has gone up to $20 trillion between 2020 and now. And so we like to bring that out and show that cost to our impact investors as part of talking about whether or not we're going to a 9% return or a 10% return or a 12% return, because I think sometimes that goes unknown to people that are looking to do well while doing good.
I want to kick it out to the audience here. So for people that you do have questions, go ahead and put them in, and we'll get to them. But as we're doing that, I guess my last kind of more just sort of question I've got is, um, what was it? I just had it. I had a good one. We'll kick it over to Kimberly if I remember it. Kimberly, can you go ahead and unmute? I know you had a question here.
Hi, thank you. Thank you for putting me on the spot. This has been really, really good. I we're ahead at a local nonprofit. I'm their small business development manager with the Center for Community Wealth Building. We work with a lot of different CDFIs. Um, None of them have this three-pillar approach that you have described. And I'm wondering, you're shaking your head. And I put a question like, are you an outlier? Are you like I'm sure you're gonna say, absolutely. Why is that? Like, is it just
Yeah,
you and your genius?
no. I'm not gonna go that far. Where I have come out, and it's interesting because um yesterday's news actually made me look real good to my board. I've said for a long time that I hope this is not controversial, that hope and philanthropy is not a business strategy. They're good, they're necessary. It's not sustainable. And so I've always felt as if we have to, while doing well for the community, recycle the dollar at a minimum, right? It can't be just dollars out. Now, what I've said as it relates to my strategy, just be very, clear in my response, is there are three main ways that wealth is generated, at least in our capitalist society, right? It is you own real estate, right? This is old JP Morgan statement, right? You own a business, right? You selling something, right? Or you're in to the business of financing the first two, right? And so, and that's why, you know, we're talking about retail investors, right? Because it's making their money work for themselves. So what we're trying to do is give people a path to wealth via this vehicle in all three lanes, right? When the CDFI industry was created under Clinton administration in '94, the idea was, hey, you know, these people aren't getting access to traditional financing. Banks just aren't looking at it as completely overlooked community, which is all true, right? That's statistically proven, and it's still an issue, right? No doubt about it. The issue, though, with assuming that there'll always be, God bless her, a Mackenzie Scott to come in and fill that gap, I just have never, and again, I'm coming from a bank, but I'm also coming from, you know, a lower income background in military town. I never saw that as being sustainable. So I've always thought to myself, we can do low interest rate loans with the CDFI fund, but then with real estate, we have to have a little more margin. And then with the private equity vehicle, we have to have even more margin so we can subsidize what we're doing with the loan fund, with the CDFI loan fund, and make it sustainable. And also weather what's being discussed in Washington per yesterday. Because I just knew, in my mind, it was always like, again, I spent my first 10
I
years
think
on.
you're going to be in high demand. You're going to be in high demand. And I'll just leave it there.
I appreciate that.
Yeah, I definitely agree. Steven had a good question. I'll let him go ahead and unmute and ask it himself.
Thanks. And Bernel, great work. And we all need to come together and really amplify your impact. Question I have is unfortunately a very critical one that we've just experienced, and that is what is your, how do you anticipate adjusting for what is really going to be an onslaught and a huge win against us in terms of what you're doing?
Yeah, no, we get $4.8 million via the CDFI fund, which is obviously part of U.S. Treasury. And, you know, we have a $28 million budget. So, you know, we're talking about real money, right? And that's us, right? That's because we started, you know, raising revenues, recurring revenues from the other businesses. Most of my colleagues in this industry, the 1,500 CDFIs out in the world, a much bigger percentage of their budget comes from the CDFI fund. Right? So what came out yesterday is a threat to not just me, but the entire industry. And, you know, my thought process on it is we just have to be very efficient about what we do. And where it makes sense, collaborations, right, to build a bigger asset base among CDFIs. And this is me kind of talking out of NJCC. This is kind of talking to my colleagues, pulling together your balance sheet, your assets under management, pooling those to go get money from the capital markets, right, is probably something people should consider if they haven't done so already. Because, you know, the great thing about Wall Street, right, they're good on analyzing something, understanding the industry really quickly, and, you know, making a calculated bet on it, and, you know, giving you financing to go do your work. The tough part about dealing with the capital markets in the way in which I think CDFIs need to move forward is, you know, they expect you to have a certain level of sophistication and understand how it all works from their perspective, and they want scale, right? Wall Street generally does not do small deals. Too many people that are looking for bonuses at the end of the year. And if that fee income, I shouldn't say that, but we all know it's true. If that fee income off those transactions don't warrant their time, then they're not going to do it. Well, most CDFIs, you know, $8 to $10 million in total assets under management, that is probably not going to drum up the level of interest from the variety of banks that we need. So my thought process, again, this is premature talking out of, you know, just bouncing ideas off the wall, is that people need to pull together their loans on their books and then go get those bonded, and that'll create liquidity to weather whatever storm we anticipated over the next 18 months to 4 years.
So if you don't mind, one
Yeah,
quick
yeah.
question. So have you been approached by some large alternative capital sources in anticipation of the squeeze that you're about to face?
Yeah, I approached them last
So
year.
you are proactive, but the capital
Yeah,
sources that saw this coming have not approached you.
I think people kind of look in 2018, same administration said we're going to reallocate $258 million from this, CDFIs to the military. So for a person like me, like even if you don't make good on the threat, I remember the threat. So I started, I cleaned up my balance sheet, sold off a lot of non-performing loans, right? And I started reaching out to alternative sources of capital because someone just told me that they may reallocate money from me that I've depended on, right? And so I don't think I'm the only one who's done that. So I think a lot of these alternative sources of capital have been contacted by CDFI preemptively. And so as new ones start to reach out to them, I don't know that they'll be shocked, surprised, and completely caught off guard, right? Whether that be donor advised funds, philanthropic organizations, the foundations, even some of the banks, they understand what we're dealing with. And oh, and by the way, they have Community Reinvestment Act credit that they have to obtain, PRI goals that they have to meet if you're a foundation, and even some of the corporate treasuries, it's still a tax benefit to invest in us. So, it is an uncertain time, but we should not operate from a position of weakness because we also have something to sell.
Keep up the great work, man.
I appreciate that. Thank you, sir.
Yeah, and I want to next. We had a good one coming in from John Niederman. John, I'll let you go ahead and unmute unless you want me to go ahead and read it here for you.
No, I can. We're a small group of people in Fort Wayne, Indiana, that's looking to create a community investment fund, and we have a CDFI here, but they are not that sophisticated like you are, and they're small. But we're working with them. But we're trying to think through what the biggest barriers are in creating, because we want as many community investors as we possibly can create interest in, and that means not accredited as well, along with accredited. And so we're trying to figure out what are the biggest barriers you have experienced as you created or are creating a non-accredited investment fund, and are you willing to share your experience so far?
Sure.
We're at the beginning stages.
Me too. The thing about non-accredited investors, if you lose their money, you take it on a lot of liability from the SEC, from all kind of alphabet soup organizations. It sounds very good to say, oh, we're going to get money from, $500 from here, $1,000 there. The issue becomes once that scales to a certain level, you have to register with your state treasury, the SEC, among others. That filing costs money, right? Then there's reporting that comes with being a registered investment advisor on behalf of those people. And so a lot of people are getting around that by working with pre-established registered crowdfunding outfits, paying them a vig or a fee to get access to their investors, let them handle the reporting and the asset management and all the regulatory liability, and just getting what's left after they take the cost of doing that reporting and their fee for raising the dollars. That would be my recommendation if it was affordable. In the meantime, again, there's 1,500 CDFIs, and there's a lot of people wanting to do it themselves. I just have to be responsible and say out loud, lending at lower costs for a long period of time, right? Providing low cost patient capital to small businesses and affordable housing development, right? It's not a profit-driven business, which means you're going to have a hard time unless you have a lot of loans under management and there's a lot of interest income coming in, paying staff, which is the biggest issue most CDFIs are dealing with, or hiring staff that are technically proficient in risk management, in underwriting loans. Like, you know, when this was started in 94, it was a lot of community development professionals that converted to finance professional. Now this has gotten super complicated, and you really need a lot of finance professionals that are going to work alongside the community development professionals. Otherwise, that risk that you're taking on and trying to do good, you know, may be detrimental in the long run. Which is why, like earlier, I was saying, pooling is where, and you know, consolidating, you can still be independent, but go to bond or go to market and hire a consultant with 5 other CDFIs and share the cost, share the risk, share the capital that you can get from Wall Street by pooling. That's my thoughts on this.
Okay, because we're not looking at a big fund. We're looking at a small fund for Main Street entrepreneurs. So in a community-based manner. So that's why we're just trying to
Loans still have to be serviced. They
Pardon
still
me?
have to be serviced. You
Yeah, I
still
know.
have to collect people's tax returns every year. You still have to do quarterly updates. You still have to figure out whether or not you're going to do credit checks. You still have to go check the operation. Like, it is a high touch bit specifically for the people we serve, right? Main Street needs more guidance and oversight. I think, again, people discount that because we want to do the right thing, but that's a high touch job, right? And it's hard to consistently pay people to do that at a smaller scale if there isn't a way to share that cost with others.
Thank you.
Yes, sir.
So given the high touch nature of the business, do you try to create community advisory boards that bring the voices of the communities in there? What do they look like?
Yeah, more than voices. We asked them to provide HUD certified down payment. I'm sorry, home ownership consulting, or if they're accounting firm, please help us prepare these people to pay payroll taxes on time. Small business development, like some of the snags or some of the things people get tripped up on are the same thing over and over again, right? Payroll taxes, being bonded and licensed to insure, like, you know, it's a rhythm to it, because just because Chad is very good at making widgets, that doesn't make him an accountant, or that doesn't make him a marketing expert or a labor union's advisors or liaison, but he still needs those services, right? And so a lot of times the best lending is lending that comes with wraparound advisory work. And that's where you lean into your local technical assistance foundations to let them, you know, be a party to sort of what I call risk mitigating transactions.
Got it. Okay.
And then the same, and naturally you get feedback on, well, this is what's working and this is what's not working. So you're still taking in consideration the voices of an entrepreneur. It's still a feedback loop, but at the same time, you are providing the type of guidance they need to avoid pitfalls that tend to lead to most businesses failing in the first 2 years.
Right. And so just to go back to something you said earlier, you said there's 700-ish municipalities in New Jersey. Have you targeted just a smaller number, or are you really trying to spread what you're doing throughout the state?
We spread what we're doing throughout the state.
Got it. Okay. So I was playing with Copilot, my little trusty AI, and I asked Copilot while you were speaking, I said, so what is the gap in people needing affordable housing in New Jersey? And the quick answer I got was 225,000 units.
Oh, I thought she thought it was 300. Okay. All right.
Well, who knows? Who knows? But still,
AI just told you I'm doing a good job. See, that number
well,
was 300,000.
but here's my point, and this is an unfair question. I'll stipulate this.
That's okay.
But you are big player in a big state with a big amount of capital that you have put together. Your state has this need. of 250,000 units, maybe 300,000. You have 500 units that you're providing affordable rent on. You're hoping to grow that to 800. How does one scale what you're doing to meet the the scale of the challenge? And I know, I mean, we all have to work together. We have to do
Yeah.
multiple things, but how do you think about that?
Yeah, partnership is the short answer. At the end of the day, here's sort of kind of speaking to the why as it relates to some of that federal funding that is so controversial right now. Someone has to have a first loss piece, or at least be willing to risk part of the capital necessary to go into disinvested communities, right? Because otherwise, banks would be so efficient that there'd be no need for a CDFI. But we know banks don't operate like that, right? Because if you don't have a certain credit score, a certain level of experience, 5 C's of credit, you're not getting a bank loan. Well, that cuts out a lot of people who are very capable otherwise from addressing that $250,000 or $225,000 225,000 unit issue you just raised. And so in working with the states, cities, as we mentioned, CDCs that do some of the advisory work, technical assistance work, we're able to identify what are the most likely successes that we can all coalesce around to make sure that this 200 years of development is a successful one. Because I think sometimes, we think about, oh, why don't you just do a scattergun approach? Everybody who wants to do affordable housing development, we give them some dollars and they go out and start building. The issue with that is there's a higher price for failure among affordable housing developers than the otherwise, right? Number one, failure probably means they're not getting another loan, right? Failure also probably means that personal guarantee that they signed to do the construction loan meant their house, right? And so it's really a much more evolved process than just saying, hey, this guy wants to do good and build some affordable housing. This lady wants to do good and build some affordable housing. We have to have concessionary capital, technical assistance from a lot of different organizations, as well as, thoughtful underwriting internally, right? This is why, what we do is so tedious, to make sure we give the right person the right amount of money at the right time to do the work of building affordable housing in New Jersey and beyond.
Got it. All right. Do you think you can close that gap in your lifetime? Or?
With a lot of help.
Good. All right. Well,
That's
I
good.
love the optimism.
We also had 2 questions here. I thought both were good from Stephen Filler. Stephen, are you able to unmute?
Yeah, hi. Hi, everyone. Thanks, Joel and Mike, for putting this together, and Bernel for doing this. Is really interesting. So I had 2 questions. One is, what's your guys' approach to climate lending, and particularly in connection with the GDRF and potential risks now coming from the federal government? So that's one question. And then the other is unrelated, but if you could talk a little bit more about how you build lending pipeline.
Yeah.
And do you work with outside partners, and how do you do that?
Sure, I'll take the first one in the order you gave it. So GGRF, we are still doing our research. We have been approached to participate, and we've demonstrated a willingness to do so. The issue with that is the regulatory and compliance covenants associated with the types of developments that will qualify, as well as the reporting that would need to go back to the government in order to not have to recapture the funds, is still being defined. And until I get very, very succinct bullet points on, what is expected as it relates to the project, the build and the specs of the project, as well as the reporting thereof, we are absolutely a captive audience to it, but we aren't participating. And then the second question, a lot of these relationships come from a number of sources. Obviously, some of them are legacy, right? It's a 36-year-old organization. But we have 70 banking relationships. Most of those banks have community development departments who know of us, given our track record and size. And so they ask us to participate on several transactions. Same thing with the economic development, executive directors and leaders in different municipalities in New Jersey and beyond. And then once you do a good job, one developer, it's also a pretty incestuous community. They talk to other developers and they refer us in that capacity as well.
Thank you.
Excellent. Also, we had one other here from John Grogan. He said he's in a noisy environment, but basically the question is around how you guys share the stories of the successes that you have. Are you guys setting up relationships with media? Are you using your own social media? What have you guys seen that works as far as how you're getting your message out there and celebrating successes?
Yeah, it wasn't traditionally something that we invested a lot in prior to 2 years ago, but 2 years ago we did start working with a PR firm. So you'll note on my LinkedIn that we do list a lot of the work we've done, and we'll probably, with your permission, republish this conversation as well. And then we send out our own newsletter to people on our email distribution chains, and we publish an annual report. So we have worked really hard to get the messaging out with statistics, and so people that understand that socioeconomic benefits are measurable, and they are occurring in all the work that we and other people in this industry do.
Yeah. I guess to wrap up, when you guys looking forward, I guess if you're thinking of a goal, a vision, a direction of, kind of where you are seeing things headed with your fund. I guess I'm curious what that looks like in your mind, but then also what do you think might be the biggest challenge that still needs to be overcome in order to get there?
Sure. So right now, as I mentioned, we're just under $700 million in assets. Our goal for 2028 is to get to $1.2 billion in assets. We'd like to double the number of people we serve to 300,000 companies and residents from where we are now, roughly around 150,000. Impediments to that, obviously, low-cost funding, both from the government as well as philanthropic organizations. And then, just continuing to be diligent in our ability to manage risk while being empathetic in our work. That is a delicate balance, one in which takes special people like my staff to walk, as well as the staffs of other CDFIs throughout the country. And from my perspective, those are the biggest things that we will have to manage to get to where we are to where we want to be.
Fantastic. Michael, did you have anything else you wanted to announce or to ask of Bernel?
Well, I think you gave us a lot of great information. And is there a nice annual report that we could maybe post along with this, just so we can get get the numbers, and then other people can listen to you and people will appreciate that.
We'll get that over.
Excellent, excellent. No more for me. I know Jen maybe has some announcements about future events that we should have her catch us up with.
Absolutely. You get the voice from the sidelines here, but our next Community Capital Live is 2 weeks from now on February 12th from 2 to 3 o'clock Eastern Time, and that's with Christina Jennings of Shared Capital Cooperative. Also, Kimberly beat me to it when she asked, is this going to be recorded? So thanks, Kimberly. We are recording it, and I will have this the recording to you by tomorrow morning. Feel free to share it with others, and we hope you can attend our next event as well.
All right. Thanks, everyone. Make sure to tune in to next time. Check out the Main Street Journal, Impact Alpha, Neighborhood Economics, and the Mindful Marketplace show on Biz Radio US. Until next time, everyone take care of each other. And remember, we are each other.
Thank you, Bernal.